I'm Erica, your tax strategist and CFO here at Paragon Accountants, and today I'm going to be talking about a topic that's on everyone's mind: why the government increases interest rates and how this impacts available financing and real estate lending opportunities this year in 2024, and what the overall economic impact looks like. Plus, we'll be discussing how long these rate hikes might continue. So let's dive in. So why does the government, specifically the Federal Reserve, increase interest rates? The primary reason is to control inflation. Inflation happens when prices for goods and services rise too quickly, which can erode purchasing power and destabilize the economy. When the Fed increases interest rates, it makes borrowing more expensive. This discourages consumers and businesses from taking on new debt, which in turn slows down spending. By cooling off demand, the Fed can help bring down inflation, stabilizing pricing across the board. In 2024, we've seen several rate hikes as the Fed tries to manage persistent inflation that's been driven by a variety of factors, including supply chain disruption, strong consumer demand, and the geopolitical tensions. The goal is to bring inflation back to a target rate around 2%, which is considered healthy for the economy. So, how does this impact you when it comes to financing and real estate? As interest rates rise, the cost of borrowing increases. This means higher interest rates on mortgage, personal loans, auto loans, and business. For consumers, this can reduce their ability to take on new debt or refinance existing debt, leading to lower spending overall. Banks and lenders become more cautious during periods of rising interest rates. They tighten their credit standards, meaning it becomes harder for borrowers to qualify for loans. This is especially true in the real estate market, where lenders are more stringent about who they approve for mortgages. Higher mortgage rates also make buying a home more expensive, which can slow down the real estate market. Potential buyers may decide to wait until rates come down, leading to lower demand for homes. This in turn can put downward pressure on home prices or slow their appreciation. For businesses, higher borrowing costs can lead to reduced investments in new projects or expansions. Companies might delay or scale back plans that require financing, which can have a ripple effect on the broader economy, potentially slowing down job creation and economic growth. So what's the overall impact on these rising rates? While the Fed's goal is to bring down inflation, the side effects include slower economic growth and potential higher unemployment if businesses scale back their operation. This delicate balance is why the Fed closely monitors economic data and adjusts its policy as needed. As for how long we can expect rates to continue rising, that depends on how quickly inflation comes under control. If inflation remains high, we might see more rate hikes throughout 2024. However, if the Fed's actions start to bring inflation down, we could see a pause in rate increases or even rate cuts in the future. The key is that the Fed will continue to adjust based on the data, so it's important to stay informed about economic trends. That wraps up today's discussion. If you found this video helpful, don't forget to give us a thumbs up and subscribe for more updates on tax, finance, and economic strategies. See you next time.